Hi, my name is Brian Burjans.
And I'm Rick Betancourt.
Welcome to another episode of Homeownership Heroes.
So, I think today we need to do some education for our LOs specifically. Let's talk about residual income and how important it is for our VA home loan benefit.
Yeah, so residual income is one of those, it's gray, right? So, and I think it can be your best friend and also your worst nightmare in the same scenario.
Absolutely.
Because I think what happens, especially with non-taxable income, is we got a lot of loan officers in our industry that like to gross up everything.
I don't know why.
And what they don't understand is that actually doesn't count toward residual.
I know, it's funny, they think that the AUS approval is gonna make a difference, and it may initially, and it gets it to underwriting, right? But listen, loan officers, if you're gonna use a gross up, which by the way, it's 15% right now, based on tax income calculations, brackets, not 25%, which that's another argument. But if you're going to gross something up, the difference between your grossed up and the actual has to be included in the residual income calculation because you can't use the gross up to increase your residual.
Right, it doesn't work that way. So what ends up happening is you got folks who take the application, right?
Yep.
And this really impacts low to moderate income borrowers that are on disability and stuff like that. So they gross it up to make it look, awesome.
Oh, like they get the 120%.
Oh yeah.
Which they don't.
Make it look awesome. And by the time it gets over the fence to underwriting backs out the gross up, and now all of a sudden you got an AUS refer,
and you're in trouble.
right? And now you're in trouble because you don't meet residual income requirements.
Yeah, from listen, loan officers out there, your best bet, number one, is to try to be conservative with your income calculations.
Sure.
Going in, run it through the AUS. Don't gross up the service-connected disability or SSDI if they have any of that. Go that route. If all of a sudden you're getting an approved eligible and your ratios are still somewhat high, you can gross up at that point in time to make the ratios look a little bit better. Maybe that will make a difference in the AUS. I'm not sure, but to go ahead and just gross it up, not account for it in the residual, and then submit it and hope it works. You're setting that poor veteran up to fail because it's probably not going to go through.
No, because 2 weeks later, your underwriter comes back with their decision, and next thing you know, you got a referral. You don't meet the residual income requirement, and now you're calling your homeowner's insurance agent and everybody else to try to get them to get a lower quote.
Oh, bump up the deductible to like $20,000,
which is definitely not doing anybody a favor.
That's not doing anybody a favor, but the LO will try to do that just to make the deal work.
Yep.
I think that, and then you see these veterans who have assets are then forced into going into FHA for the house that they're under contract with that they can't get out, or they may not want to get out, right? And now they're stuck and they're not using their VA benefit, where if we had done more of a meticulous approach to quantifying their ability to repay and their income and their residual income calculations properly, they should have done that. And I think it's important when you're an LO, you should be using some sites that help you figure out, if you don't have the pay stub, right? What the FICA, Fed, Social Security, and what the deductions are, and be sure to put that information, please, in your LOS system, whether it's a proprietary through Caliber, or it's Encompass, or it's Calix, New NAM All In. Put the residual income figures together inside your LOS, so that way, when you run your AUS, it's accurate.
Yep. And the great part about residual is it can be your best friend too. So we just talked about nightmare situations. So when you have a customer that has high debt to income ratio, some people after it hits 41% check it out and go to another program because they think it, for some weird reason, 41% is the max DTI.
Yeah.
But when you get somebody in the high 50s, that's where residual comes in to help you get the deal done with a high DTI.
And that's where you have to really tell the story. So, you have we're not in the business of just putting veterans in homes to make money, okay? If that's kind of LO that you are, you've got to change the way that your business practice works. But if you ask the story and create the story on your transmittal summary for VA, if you got a high ratio, 55, 56, 57%, but you have your residual income, and there's a non-applicant spouse there that's bringing another $10,000, $20,000, $30,000 a year in, we know in reality that the DTI is significantly lower than that. That's how you make a smart credit decision when you're working with a veteran. Listen, for the love of God, just don't put a veteran in a 58, 61% DTI home because you need to get paid and pay your bills that month. That's just not the way you originate loans.
So, again, residual can be your best friend or it can be your worst nightmare.
Absolutely.
Educate yourself on residual income and make sure you're doing yourself a favor and really understanding the type of client you're working with and the economics of their situation.
Help that veteran use their benefit to get themselves into a home.
Well, we hope you found a lot of value in our discussion today, and we hope you tune in next time on Homeownership Heroes. My name's Brian Burjans.
And I'm Rick Betancourt.
We'll see you next time.
Thank you.
This is Mortgage News Network.